What the topic of today's video is, just a simple topic about smaller deals and financing for smaller deals. So the problem with smaller deals is really on the bridge loan side, right? There's a bunch of programs on the agency side for small balance loans, Fannie Small, Freddie SBL, and they've really got that down, and they've figured a way to originate these small loans and still keep the transaction costs low relative to the loan size, and the spread is very good. So it's a great loan product, and it keeps the market competitive. The trouble is with bridge loans. Bridge loans that are less than $5 million are very tricky, and the price, it's a step. It doesn't even move kind of linearly or inversely, right? As the loan gets smaller, it doesn't move linearly in the rising costs, both transaction and interest rate for a small bridge loan. It's just a step. It's almost, you've got the lenders that are willing, your typical CLO lenders that are willing to do 5 million plus loans, 10 million plus loans, 15 million plus. Obviously pricing is fantastic and gets better the bigger the loan is. So on the bridge loans that are $3 million bridge, $4, $5 million bridge, that's very cuspy. That's where things get tricky, because you might go from, if the loan were just a little bit larger, you'd get a bridge loan for, L plus 375, L plus 400. But then if it's just $500,000 smaller and you can't find a typical, cheaper CLO lender, then you're going to be paying 5%, 6% or more to get that same loan. And what I've also seen for these smaller bridge loans is the leverage is worse. Not exactly sure why. I think it's just because they can, right? It's not as competitive a market. And I get it too, right? You're out here, your business has to be volume by nature because you're originating small loans. And so just to protect yourself, you max out at lower leverage, because you can't underwrite every single deal perfectly and size to max leverage. So I've also noticed that. So you get less leverage, pay more on the rate, and it really, obviously just with those two things, absolutely kill a deal. So those cuspy deals are really interesting, and obviously that makes you want to go perm as much as you can for smaller deals, because if you are trying to finance something with a $3-4 million bridge loan, you very well could be stuck with that higher rate, and then, like I said, it kills the deal, and so the deal is not transactable. Doesn't make sense, or you need a price discount from the seller, and obviously that's not happening much these days. So with that in mind, there's not really a solution. If you have a deal that, it kind of goes back to the original premise, and this is something that we've been saying for a long time, which is that you really should only be doing a bridge loan if the deal really justifies the bridge. And how does a deal justify a bridge? Well, it needs to have enough value creation, but not just value creation, because you could overpay for that value creation. You need to actually have a high enough return on cost that is greater than the market cap rate, so that way you can actually exit the bridge and refi into a perm loan, right? And that's the exit test, the refinance exit test. So at the end of the day, that's what determines the appropriateness of a bridge loan, not necessarily how much you're raising rents or how much capex you're spending. How much capex you're spending does play a role in our decision making about a bridge loan, because even if a deal is stabilized and we could go perm, if we're spending $10K a unit and that's resulting in our all-in leverage or loan to cost being 60, 65, we probably are going to want to go bridge, just because that's not an optimally financed deal in our opinion. We like more leverage. So that way we maximize levered returns, maximize tax benefits per dollar of equity. So it's important to optimize leverage, not necessarily maximize leverage, right? And make sure that the financing matches the deal. So on the small balance, right, you could be in a position where you're stuck, and honestly, I think you might just have to pass on the deal, right? If it can't go perm, but the bridge is too expensive. So that is one of your only options. And then, like I said, the other option is to really seek out those deals that actually justify a bridge. And then the thing is, with the small balance deals, it has to be even more so. It has to even more justify the bridge, because the bridge is that much more expensive and potentially that much less attractive. So that's the trouble there, and maybe the argument could be made that for smaller deals there's less efficiency and there's more upside. You've got less sophisticated owners that you can buy from, and really solve for higher returns, which can then justify that more. You can essentially afford the more expensive bridge loan. but that is tricky. So I think if you're in this predicament and you want to do a bridge loan deal and you're in that cuspy range, just make sure that you do a slightly larger deal so that way you can make it happen. Or maybe you can do 2 smaller properties in one portfolio loan, so that way it puts you into a larger loan category and you can get access to more favorable lending terms. Or you can just pay more so that the leverage is more and then you get a bigger loan. Just kidding. So yeah, those are my thoughts there about small balance bridge loans and how that affects your underwriting, your pricing, your business plan, and why you may want to avoid them altogether. Thanks for watching.